$480 billion. That is not a rounding error. That is not a bad day on the calendar. That is the amount of wealth that was erased from American markets in a single Monday afternoon, February 24th, 2026, in one trading session. While most Americans were at work, at school, going about their lives, $480 billion of wealth quietly ceased to exist. And here is the part that no one in the mainstream financial media is telling you. Goldman Sachs, the most powerful investment bank on Wall Street, the institution that manages trillions of dollars and employs the sharpest financial minds in the world, has just officially identified the stock market crash as the single biggest threat to the entire United States economy. Not inflation, not recession, not China, not the federal deficit. The market crash. Goldman Sachs said it out loud. And that, more than any headline, more than any government statistic, should terrify you. Because Goldman Sachs does not say things like this by accident. When Wall Street's most profitable bank names the implosion of the very market it depends on as the top economic risk, you need to ask yourself one question. What does Goldman already know that you do not? The answer to that question is what this video is about. And the answer is far worse than you are being told. For the last 3 years, the American financial system has been living inside a carefully constructed fantasy. After the chaos of 2022, central banks and politicians worked overtime to restore a sense of normalcy. The Federal Reserve raised interest rates, inflation cooled slightly, and the stock market, powered by the artificial intelligence boom, roared back to record highs. The S&P 500 climbed past 6,800. Analysts called it a soft landing. The official line was that the United States had beaten the odds and emerged stronger than ever. But underneath that polished surface, the structural rot was accelerating. And on Monday, February 24th, 2026, the first cracks became impossible to ignore. In a single session, investors who had placed enormous bets on artificial intelligence suddenly started asking a question that nobody on Wall Street wanted to confront out loud. Where are the actual profits? Before we expose exactly how Goldman Sachs is already repositioning itself while reassuring you that everything is fine, please make sure you are subscribed to the channel and have turned on the notification bell so you do not miss our daily updates as this crisis accelerates. And comment down below right now with your answer to this question. Stocks or cash? Where is your money positioned right now? Tell us in the comments, because what we are about to reveal will determine everything about how you should answer that question. To understand the full magnitude of Monday's collapse and why Goldman Sachs is now sounding the alarm with unprecedented directness, you need to understand what actually drove markets to $46 trillion in the first place. Because it was not organic economic growth. It was not productivity miracles. It was not innovation generating real, measurable profits flowing back to shareholders. It was a bubble. And not just any bubble. It was the artificial intelligence bubble, the single most aggressively marketed investment narrative of the modern era, now showing its first catastrophic fractures. Here is how the machine worked. Starting in 2023, every major technology company in America began announcing extraordinary, almost incomprehensible spending plans for artificial intelligence infrastructure. Microsoft committed $80 billion to build AI data centers in a single fiscal year. Amazon pledged more than $100 billion. Google followed with $75 billion. Meta announced $60 billion. All in. Together, these 4 companies alone committed over $300 billion to build the infrastructure of an AI-powered future. The stock market responded with pure, unrestrained euphoria. Nvidia, the company manufacturing the AI chips that power these data centers, became one of the most valuable companies in the history of capitalism. Technology stocks surged to levels that defied every historical valuation metric. The S&P 500 rode the wave to record after record. Retail investors poured their savings in. Pension funds loaded up near the top. Index funds became so dominated by 5 or 6 technology names that owning the entire market effectively meant owning a concentrated bet on artificial intelligence delivering returns that would justify prices no historical framework could rationalize. But there was a question that Wall Street refused to ask publicly and now cannot avoid. What is the actual return on investment of $300 billion in artificial intelligence spending? The answer, as of February 2026, is almost nothing measurable. Billions of dollars of AI chips, servers, and cooling infrastructure are running enormous electricity bills. The revenue from actual AI products sold to consumers and businesses is a fraction of what the investment requires to justify current valuations. Companies are spending as if artificial intelligence will be the most transformative technology in all of human history. But the earnings to justify these stock prices have not arrived. They are not visible on any horizon. This is the textbook definition of a speculative bubble. Valuations are priced for a perfect future that has not materialized. When the gap between collective expectation and measurable reality becomes too wide, the market does not gently adjust. It corrects violently and without warning. On Monday, February 24th, that correction began. Investors who had driven AI-adjacent stocks to historically extreme price-to-earnings multiples suddenly started pricing in a less comfortable version of reality. The selling was concentrated and brutal. Stocks linked to the artificial intelligence narrative fell sharply as the market began to confront the possibility that many investors had not wanted to seriously consider. What if the extraordinary returns never arrive at the scale that was priced in? Goldman Sachs, watching this unfold in real time across their trading desks and research divisions, published their assessment with the kind of directness that institutional economists normally avoid. The stock market correction is the #1 risk to the United States economy. Not foreign adversaries, not energy prices, not banking sector fragility. The market itself. Goldman Sachs is telling you that the primary instrument of American financial confidence has become the greatest threat to American financial stability. When a bank that profits from rising markets says the market crash is the biggest danger, they are not making a speculative prediction. They are reading the data they have already positioned around. The smart money is not warning you because they are being generous with information. They are warning you because they are already out. They are building their lifeboats while telling you to stay on the ship and enjoy the buffet. But the story does not stop there. The artificial intelligence bubble is only the most visible layer of what is breaking down simultaneously. To understand why Goldman Sachs is sounding the alarm with such unusual clarity, you need to go beneath the surface of the stock market and examine what is happening concurrently in America's corporate credit markets, inside the Federal Reserve's own policy deliberations, and in the balance sheets of American households right now. Let us start with corporate America's debt problem. During the years 2020 and 2021, when the Federal Reserve drove interest rates to effectively zero and flooded the financial system with trillions of dollars in emergency liquidity, corporations went on the greatest coordinated borrowing spree in modern financial history. They issued trillions of dollars in bonds and leveraged loans at interest rates of 2, 3, and sometimes even 1%. The money was essentially free. Financial engineering teams built entire business models on the assumption that it would remain permanently free. It is not free anymore, not even close. J.P. Morgan, the largest bank in the United States by assets and the most influential voice in global credit markets, has now definitively removed all expectations of Federal Reserve interest rate cuts from their entire 2026 outlook. After months during which Wall Street consensus assumed the Fed would rescue equity markets and overextended borrowers by slashing borrowing costs, J.P. Morgan has officially abandoned that assumption. There will be no cavalry arriving. There will be no flood of cheap money to bail out speculative positions built on the premise of rate relief. Money will remain expensive throughout the entire year. And as those essentially free loans from 2020 and 2021 begin to mature and demand refinancing, throughout 2026, corporations across America are discovering a brutal, inescapable arithmetic. The loan they took at 2% now must be rolled over at 4, 5, or 6%. Interest expense is doubling, tripling, in some cases quadrupling. The earnings models that made their businesses profitable at near zero rates simply do not function when the cost of capital has tripled in less than 3 years. This is what credit market professionals call the debt maturity wall, and 2026 represents the apex of that wall. Hundreds of billions of dollars in corporate debt are coming due simultaneously in a higher-for-longer environment that no one who designed those loans anticipated surviving. Companies that borrowed freely through the pandemic now face a stark binary choice: refinance at punishing new rates and watch profits evaporate, or default on their obligations. The math simply does not work for a significant number of them. The contracts say the money is due, the balance sheets say the money is not there, and yet the Federal Reserve, rather than riding to the rescue with rate cuts, is internally discussing moving in the opposite direction entirely. The minutes of the Federal Reserve's January 27th and 28th meeting, released by Bloomberg on February 18th, 2026, contain a revelation that should have dominated every financial headline for days. Several members of the Federal Open Market Committee discussed scenarios in which upward adjustments to interest rates could be appropriate. Rate hikes, not pauses, not gradual cuts. Rate hikes. Federal Reserve officials were actively contemplating making borrowing more expensive at the exact moment when corporate debt walls are maturing, consumer debt is at all-time records, and the stock market is showing its first signs of serious structural stress. NBC News confirmed the story independently. Yahoo Finance described the revelation as a shocking twist in the 2026 interest rate outlook. The Federal Reserve is not coming to save the market. The Federal Reserve may be the source of the next shock. How is this possible? Because the Federal Reserve is trapped in a policy bind of its own making that has no comfortable exit. Inflation has remained stubbornly above their 2% target for nearly 5 consecutive years. Every time policymakers declared victory, inflation returned. Now, with new rounds of tariffs adding cost pressure throughout the entire domestic supply chain, inflation is threatening to re-accelerate precisely when the economy most desperately needs relief. If the Fed cuts rates into a renewed inflation surge, they destroy decades of institutional credibility and set off the very inflationary spiral they spent 3 years fighting. They cannot do it. The institutional mathematics prevent it. The economy is simultaneously slowing and overheating. That combination is not supposed to be possible according to conventional economic theory. It is happening anyway. Gross domestic product grew at only 1.4% annualized in the fourth quarter of 2025, dramatically weaker than consensus expectations, partially driven by the economic disruption of the government shutdown. Strip away the contribution from federal government deficit spending, which has become the dominant and perhaps only engine of reported economic growth, and private sector activity is essentially flat. We are borrowing staggering sums from future generations to manufacture the statistical appearance of economic health today. For every dollar we add to the national debt, the actual measured economic return is declining. This is the mathematical signature of a debt-addicted economy approaching the point of exhaustion. The bond market has been quietly communicating this reality for months. The equity market is now beginning to price it in, one painful sell session at a time. The American consumer, however, is not slowly processing economic data. The American consumer is already living the consequences of this system reaching its limits. American households, according to data from the Federal Reserve Bank of New York, entered 2026 carrying $18.8 trillion in total outstanding debt, a record that has never been approached in the history of this republic. Credit card balances alone have climbed to $1.28 trillion, an all-time high across all 26 years of data collection. Across all categories of consumer borrowing, 4.8% of outstanding debt is now delinquent. That is the highest rate since 2017, and it is still moving upward. These are not abstractions. These are people who cannot meet their minimum credit card payment this month, cannot keep current on their auto loan, cannot service the debt they took on when the economy looked different and the future seemed more forgiving. These are the people who were supposed to sustain the 70% consumer spending economy that analysts have been citing as evidence of American resilience. They are not resilient. They are exhausted. They have run out of credit capacity. They have spent through every dollar of pandemic-era savings. They have borrowed against everything that could be borrowed against. And Goldman Sachs sees with complete clarity what happens to corporate earnings and stock valuations when those consumers finally stop spending. $480 billion vanished on a Monday. It was only the first chapter of a much longer story. But here is where the situation moves from deeply troubling to genuinely catastrophic. Because the consumer debt crisis and the AI bubble correction and the corporate debt maturity wall are all unfolding simultaneously alongside a fourth structural failure that most Americans are entirely unaware of: the systematic overexposure of retirement savings to the exact assets that are now beginning to correct in ways that the underlying fundamentals demand. Most Americans have no detailed understanding of how their 401k or state pension is actually invested. They see a number on a quarterly statement and assume that professional managers are protecting their future. What they do not see is that the default investment options in the vast majority of American employer retirement plans are passively managed index funds that mechanically mirror the S&P 500. And the S&P 500 has evolved over the last decade into the most concentrated and internally fragile large-cap equity index in modern financial history. The 5 largest companies in the S&P 500 now represent approximately 35% of the entire index by market capitalization weight. If you own a standard S&P 500 index fund inside your retirement account, 35 cents of every dollar you believe is diversified across 500 American companies is actually concentrated in 5 technology firms whose valuations are built entirely on the artificial intelligence narrative that is now developing its first visible cracks. When those 5 stocks correct, the index corrects. When the index corrects, passive funds sell automatically and uniformly across all 500 names. When passive funds sell uniformly, every company in the index falls regardless of its individual financial health, its earnings, its dividend, its competitive position. It is a mechanical amplification loop built directly into the architecture of the modern retirement savings system. And it is beginning to activate right now, as Goldman Sachs watches and calculates. public pension funds face a related but distinct catastrophe. These funds, which are legally obligated to pay fixed retirement income to millions of government workers, including teachers, police officers, firefighters, and civil servants, use an assumed annual rate of return to determine whether they have sufficient assets to meet future obligations. Most public pension funds in the United States assume returns of 7.5% to 8% per year. Goldman Sachs's own institutional research now projects expected real returns on the S&P 500 over the next decade at approximately 3% annually. That is less than half of what pension funds need to remain solvent. The underfunding gap this creates is not a future projection. It is a present mathematical reality compounding silently every quarter, that stock valuations remain disconnected from fundamental earnings reality. When pension funds are finally exposed as catastrophically underfunded, the consequences do not fall on Goldman Sachs or JP Morgan. They fall on every taxpayer in every state. Benefits get cut. Retirement ages get extended. State legislators face impossible choices between funding pension obligations and funding schools, infrastructure, and emergency services. The pension crisis in America is not approaching. It is already embedded in balance sheets across the country, waiting for a sustained equity correction to drag it into the light. The correction has begun, but the most dangerous layer runs even deeper. Because beneath the consumer debt crisis, beneath the AI bubble, beneath the corporate debt wall, beneath the pension underfunding, there is a final structural failure operating at the level of the Federal Reserve's own policy credibility. And that failure is the one that eliminates the last backstop that has kept this entire system from pricing in reality. For the last 3 years, financial markets have operated on a single foundational assumption: that whenever conditions deteriorate sufficiently, the Federal Reserve will cut interest rates and flood the system with liquidity. This assumption was not merely an investment strategy. It was the structural confidence on which every valuation multiple, every leverage ratio, every risk appetite across the entire financial system was calibrated. Markets were not pricing economic reality. They were pricing Federal Reserve intervention. JP Morgan has now told institutional investors this assumption is invalid for 2026. No cuts. Money stays expensive. And the Fed's own internal deliberations reveal that some members are actually discussing making money more expensive still. This is the removal of the last psychological support beneath the most overvalued equity market in a generation. When the belief that the Fed will always save the market is shattered by the Fed's own disclosed intentions, the repricing that follows is not gradual. It is a revaluation at a velocity that most retail investors are not positioned to survive with their savings intact. Your bank account is not a vault. It is a highly leveraged claim on a financial system that is operating with diminishing buffers and accelerating stress. Your 401k is not protected by the label on the envelope. It is exposed to the same concentration risk, the same AI bubble, the same passive indexing doom loop that Goldman Sachs is now publicly naming as the primary economic threat. Your deposits at your local regional bank are sitting inside institutions that hold commercial real estate loans that are now defaulting at rates exceeding the peak of the 2008 financial crisis, according to data from TREP, the leading commercial mortgage surveillance firm. And the Federal Deposit Insurance Corporation, the safety net that American depositors have trusted for nearly a century, holds approximately $129 billion in its insurance fund to backstop tens of trillions of dollars in total deposits. If you have more than $250,000 in a single account at a single institution, amounts above that threshold are not protected by the FDIC. But there is a provision of federal law that most Americans have never encountered. Under the Dodd-Frank Act, in the event of a major systemic banking failure, your uninsured deposits can be legally converted through a process called a bail-in into equity of the failing institution. Not cash returned to you, not a government check. Shares of stock in a bank that is collapsing. Potentially worthless shares in a bank that is collapsing. By the time the government announces there is a crisis, the bail-in mechanisms will already be in legal motion. By the time your morning news anchor looks visibly worried, the capital will have moved. By the time they admit there is a problem, the solution they have already implemented will include your savings as part of the resolution. The window of opportunity to act is not closing sometime in the future. It is closing now, in real time, as Goldman Sachs publishes its warning and J.P. Morgan removes its rescue assumptions, and the Federal Reserve discusses hiking rates while the economy grows at 1.4%. Preparation is still available, but preparation taken now is worth exponentially more than preparation taken after the catalyst event. First, distribute your cash holdings across multiple financial institutions to maximize FDIC insurance coverage at $250,000 per account per institution. This single action ensures you remain fully protected even if your primary bank encounters distress. Second, research the commercial real estate loan exposure of any regional bank where you hold substantial deposits. FDIC examination data is publicly available. Banks with concentrated CRE lending exposure are the most vulnerable institutions in the current environment. Know where your money actually sits. Third, open an account at Treasury Direct and begin holding a portion of your liquid savings in short-term Treasury bills purchased directly from the federal government. Money held at Treasury Direct is completely outside the commercial banking system, not subject to bail-in provisions, and backed directly by the federal government. Fourth, begin systematic accumulation of physical precious metals in your direct personal possession. Not gold ETFs, not paper certificates, physical gold and silver that you control. Central banks around the world are buying gold at the fastest rate in over 50 years. They are not doing this because the financial system is sound. Warren Buffett has built the largest cash and liquid asset position in Berkshire Hathaway's history. The smart money moves toward real assets when paper assets become dangerous. You need to be your own central bank before the central banks announce why you should have been. Fifth, conduct a thorough audit of your variable rate debt, credit cards, adjustable rate mortgages, home equity lines of credit. In a sustained higher-for-longer environment where economic conditions deteriorate, variable rate debt becomes a weapon aimed directly at your financial stability. Reducing this exposure is not optional discipline. It is active survival strategy. 400 household debt hit $18.8 trillion. Consumer delinquencies reached a 9-year high. The artificial intelligence bubble recorded its first major fracture. Pension funds are operating on return assumptions that Goldman Sachs' own research shows are mathematically impossible to achieve. The pieces are in place. The data is real. The sources are Goldman Sachs, J.P. Morgan, the Federal Reserve Bank of New York, the FDIC, and TREP. The institutions whose professional mandate is to maintain confidence in the financial system are now the ones confirming, in careful measured language, that the financial system is under severe and accelerating stress. Most people will be blindsided by what comes next. You now know exactly why it is happening, what the mechanisms are, what the timeline looks like, and what specific protective actions are available to you right now. Subscribe to this channel and turn on the notification bell immediately. This situation is developing faster than any weekly news cycle can track, and you cannot afford to be even 24 hours behind on developments of this magnitude. Share this video with anyone you know who has retirement savings in stock market index funds or deposits sitting in regional banks. You may give them the information they need to protect something they spent a lifetime building. The algorithm suppresses content that challenges the official economic narrative. So the only mechanism by which this information reaches the people who need it is you. You have the information. You have the data. You have the sources. Now you have the choice to act. In a world where financial truth is buried under institutional optimism and carefully managed market commentary, knowledge is your armor. Preparation is your shield. The storm is already here. The window is open. Act while it still is.